On May 6, 2010, Wall Street was having a bad day. Stock prices were down for a few days, and fear about the debt crisis in Greece caused even more ruckus in the market. But out of the blue, this happened.
It's the euro and the equities. They're ping-ponging back off each other.
What the heck is going on down here?
All of a sudden here, we started hearing screaming, buy, buy, buy.
To give everyone some context, in 2010, Greece found itself in a bit of trouble. The country's ever-increasing debt, paired with loss of tax revenue due to tax evasion, culminated in Greece's government taking extreme measures to not go bankrupt. While the US wasn't affected directly, the fear of the 2008 crisis was still looming on the public mind, and the possibility of this crisis spreading like wildfire across Europe sent a tremor across Wall Street. While this was going on, traders were eyeing an opportunity. Amidst global fears, like a certain debt crisis for example, volatility, that is uncertainty in the market, increases exponentially. While this is a nightmare for any investment manager, it is a golden opportunity for any trader, with many traders buying and selling contracts in minutes, with some even using bots to bring that time to milliseconds. These traders are called HTFs for their high-frequency trades occurring every second. And on the morning of May 6th, all these elements came together, culminating in the flash crash. In the morning, it seemed like an ordinary day, an overall negative day, but still. The market began in red as the previous days, still carrying overly negative sentiments, fearing a potential default on Greece's economy. The trading floor was a total mess, with people yelling and all the screens showing red. And then, at 2:32 p.m., a sell order was placed. And after that, chaos broke loose. Prices of every stock and index started dropping rapidly, with no end in sight. Many people thought it might be an error. A drop this huge wasn't possible, but everyone soon realized this was no error. The market was actually crashing, and soon the nation began to panic. It was a mess, with everyone shouting with anger, regret, and confusion. The ticker was going down, with losses rising ever higher. People wondered, had the worst come true? Had Greece sunken with its debt crises, taken over Europe? And then the ticker stopped. For the next 5 minutes, all trading was halted. A circuit breaker was hit, and after the break, the market normalized, slowly recovering to close to its original value. And as the market closed, everyone just had a single question: what just happened? There was no economic wildfire across Europe. This wasn't an unexpected event. This was unfathomable. Losing $1 trillion and recovering it all in 20 minutes wasn't an everyday occurrence on Wall Street. After the crash, a few theories emerged. Some believed the crash occurred due to a misclick, saying a big mutual fund accidentally created a large sell order for PMG, which started a chain of algorithmic trades leading to the crash. This theory was later disproved, twice as a matter of fact. Another idea floating around was that the New York Stock Exchange was having technical problems causing delays in the signals up to 5 minutes, and would give old quotes to traders indicating as if they were current. While this idea had some merit, there wasn't any substantial evidence to back this up. Many theories were proposed for the next few months, but none had a definite answer. The question of what happened in the 36 minutes was truly intriguing. 5 months later, the SEC released a report trying to explain what exactly happened. Let's roll back to the day of the crash. At 2:32 p.m., a sell order by Waddell & Reed was placed. While this might seem like a routine occurrence in the world of the stock market, the size and how it was being executed was the interesting part. Rather than placing a manual order, Waddell & Reed had created a bot to sell exactly $4.1 billion of assets. And the interesting part, the bot wasn't given any direction on how fast it should sell or at what price. If given the chance, the bot might have sold a stock worth $1,000 for even $1. This sell order had plummeted the market in a few seconds, and to make it even worse, the other bots, the HTFs, were the ones to buy it. Later, they tried to sell them to other HTFs, creating a hot potato chain with bots selling to other bots at a lower price, which spiraled the price downward even more. This hot potato chain is the main reason for a $4.1 billion trade to end in $1 trillion loss. But there is still something missing. The HTFs on their own might have caused a small gradual crash in the span of 5 minutes, but not to the extent of $1 trillion. There was someone or something that was artificially lowering the prices, even more so than any HTFs could do on their own. So who was it? Another bot, or even a large firm trying to benefit even more from this incident? While the flash crash was solved in 5 months, this one would take another 4 years to uncover. In April 2015, the United States Department of Justice, along with CFTC, filed several charges of market manipulation, electronic fraud, and spoofing with a single name on it. Navidrasingh Sao, or Nav, was a self-taught trader, trading from his parents' home in Hounslow, London. He saw the pattern the HTFs were making. The way they traded had made the market very twitchy, and he used that twitchiness to place thousands of orders before quickly cancelling or changing them. This allowed him to make genuine buy or sell orders at a profit as the price swiftly rose or fell. Authorities declared Nav had a significant role in the crash, with the media dubbing him the Hound of Hounslow. But let's roll back the tapes a little. Nav was definitely a trading savant, but he wasn't a fraudster. Quite on the contrary, many times he was the one losing money to these fraudsters. Nav was a simple guy, living a simple life. He had made $40 million to his name but did not use a dime for luxury. Furthermore, he was on the autistic spectrum and saw trading as a video game of winning and losing. Even authorities accepted the fact that Nav was extremely helpful in any court proceedings and reduced his sentence from years in prison to a few months in home arrest. So who was responsible? While Waddell and Reed and Nav had a significant role in the crash, they cannot be solely blamed for this incident. The major blame, in an ironic twist, was on the system itself. The market, in its goal to squeeze every cent of profit, had become so fragmented and fragile that any trade could collapse the entire system in a few seconds. While the bots were a rudimentary version of what we have today, their power was so significant that they could crash a system in minutes. So imagine what could happen if an AI were given even a fraction of control over the market. Thanks everyone for watching this long. Hope you all liked it. I am trying different content to see what sticks, so if you have any niche idea or concept I can try, let me know. Also, I am trying various editing styles, but I think this is the last one. If you have any feedback, let me know. Bye for now.